So let me ask you something. You spent months, maybe years, finding the right property. You ran the numbers 100 times, you negotiated the deal, you closed, and then you handed the keys to a property manager you found by Googling for 5 minutes and picking whoever had the nicest website. While it's true that even a great property manager can't overcome a poorly structured deal, a bad property manager can wreck a great deal. This hiring decision is where many investors lose. Not at acquisition, not at financing, right here in the hiring decision that affects every single dollar your asset produces. Today we're fixing that. I'm Tyler Casey, founder and CEO of ProX Property Management, where we manage over 2,100 units across multiple markets. I've seen what good management does for an asset. I've seen what bad management can do even faster. And today I'm going to walk you through exactly how to vet, interview, and select the right property manager for your portfolio, so you stop leaving money on the table and start sleeping at night. This is the Ideas in Capital show. Let's get into it. So section 1, this is going to be about where to start your search. And it's very simple. It's going to sound silly, but before we even get into the interview questions, this is how you build your list of candidates. And a simple Google search is as good as anything. Search for property managers in your market. You'll get websites, reviews, ratings, and pricing in some cases right out of the gate. That's your starting pool. Now here's something most investors get wrong when they're reading reviews. They see a property manager with a handful of one-star reviews from tenants and they immediately cross them off the list. Don't do that. Some negative tenant reviews are actually a green flag when you're the owner. It can mean that property manager isn't bending to every tenant demand. It means they're not spending your money on repairs the tenant caused. It means they're not refunding deposits that were legitimately earned. A property manager who gets 5 stars from every tenant is sometimes doing it at your expense. What you want to look for is a pattern. Legitimate complaints about unresponsiveness or major maintenance failures, those matter. Tenants complaining about being held accountable, that's actually a good sign. Get 3 to 5 candidates on your list, then it's time to interview. So this is where we're going to get into the meat of the topic today. I'm going to give you the 21 questions that every investor should ask a potential property manager in an interview. This is what you should be asking any property manager you're considering. And more importantly, I'm going to give you some insight into what the right and wrong answers look like. So question 1, how long have you been in business? This is just a resume question. You want to know if they've been through market cycles. Have they managed through 2008, through COVID? Anyone can successfully do lease ups in a hot market. The real test is how an operator performs when the market gets difficult. Rising vacancies, tenant defaults, distressed owners. Longevity tells you they've been tested. Question number 2, what types of properties do you manage? Single family, multifamily, commercial. These are entirely different operating models. Make sure they specialize in what you own. A company that primarily manages single family homes may not have the system, staff, or vendor relationships to handle a 50 or 100 unit apartment complex efficiently. Alignment matters, although there are some companies who do single family portfolios and multifamily management well. There are very few who do residential and commercial well. Question 3, how many units are you currently managing? 300 or more is a solid benchmark. That number tells you they've built real infrastructure, staffing, systems, processes, vendor networks. Under that, you're potentially working with an operator who's still figuring things out with your property. Bigger isn't always better, but scale does matter in property management. Question number 4, what are your management fees? Nationally, you're typically looking at 8 to 12% of collected rents. 10% is pretty standard. But the conversation most investors don't have, ask directly whether there's room to negotiate the percentage as you grow your portfolio with them. If you're bringing 3 properties now and plan to bring 5 more, that's leverage. Use it. A good property manager wants your long-term business and will price accordingly. The bigger your portfolio, the lower your price should be. Question 5. Do you charge a leasing fee? Most do. Anywhere from 75 to half or a full first month's rent per new lease executed is typical, depending on your market and asset type. What you want to watch for is a company charging half a full month's rent as a leasing fee. That needs serious scrutiny. It's justified. Competitors in the market are charging it. The leasing fee structure can significantly affect your cash flow if you have high turnover, but watch out for the high half for first month's rent leasing fees. Question 6, are there any annual fees? Some companies charge an annual account renewal or administrative fee. It's not inherently bad. Just know what you're agreeing to and factor it into your real cost of management. Questions 7 through 10 all cover maintenance, which is a pretty big make or break category. This is where a lot of property managers lose owners and where a lot of owners get quietly taken advantage of. Ask them, what is your process for handling repair requests? You want to hear about a defined workflow, a ticketing system, a response protocol, a contractor dispatch process. If they say we just call someone or we Google and figure it out, that's not an answer. Then ask, do you mark up contractor invoices? This is a big one. Some property managers take a 10 to 20% cut on every maintenance job they coordinate. At ProX, we don't mark up contractor work, period. That's a competitive differentiator, but many companies do, and it's not always disclosed up front. Ask directly. Ask about response time. What's their standard response window for a maintenance request? What about after-hours emergencies? A broken HVAC in July shouldn't wait until Monday. And then ask, do you have multiple contractors on hand for each trade? If their only plumber is unavailable, what happens? Redundancy in the vendor network is a sign of operational maturity. So question 11, how do you collect rent and who keeps the late fees? You want to hear the words online portal and ACH. Electronic collection isn't optional for a professional operator. It creates a paper trail, reduces float time, and eliminates cash handling entirely. On the late fee question, most of the time late fees go to the property manager. That's fairly standard. But confirm it so there are no surprises. This is oftentimes negotiable for a larger portfolio. Questions 12 and 13 pertain to lease violations and evictions. Ask them, what's your eviction process? Give me timelines, give me approximate costs. If they can't answer this with specifics, that's a problem. A professional property manager has done evictions, many of them. They know exactly what the legal timeline looks like in their state, what it costs, and what triggers the process. Vague answers here often mean they're either inexperienced or they avoid confrontation at your expense. More eviction experience is generally better. It means they enforce leases. Enforcement protects your asset. Question 14. What reports do you provide and what software do you use? Reporting is your visibility into your investment. You need to be able to see income, expenses, maintenance history, rent rolls, and vacancy metrics. And you need to be able to pull historical data when you need it. If they're running on spreadsheets or QuickBooks with no owner portal, that's a limitation. Look for platforms like Appfolio, Buildium, or other purpose-built systems. Some bigger operators have their own system. The software is a direct reflection of operational sophistication. Question 15. Do you inspect the property? If so, how often? You want eyes on your property. A 90 to 180 day move-in / mid-lease inspection plus an annual renewal inspection is a reasonable baseline. Some companies charge a fee for these. That's fine. What's not fine is a company that never physically inspects your property. They exist and they are a major liability. Problems compound in the dark. Inspections catch them early. Questions 16 and 17. Rent increases, a confidence test. Ask them, how often do you raise rents and what does a typical increase look like in this market? What you want to hear. We raise to market at every lease renewal if not already there or if the tenant does not start at well below market. What you don't want to hear is anything that sounds like they're avoiding the conversation. We raise when we feel the time is right, or we try not to upset the tenants. There can be some nuanced strategy to the rent raise process, especially in a value add project. So if you're doing a value add project, they should have good insight into how to best maneuver very below market rents. Some property managers, though, are just scared to charge market rent because they're afraid of vacancy. The fear costs you money every single month you're under market. Confident operators raise rents, understand the market, and can back it up with data. Those are the ones you want. Question 18. This is another one. So ADU experience. If you're in a market, and it's a big one in Northwest Arkansas now, where accessory dwelling units are a value add opportunity, ask about it. Can they help you understand the rental premium in ADU ads in your specific submarket? Do they have experience managing properties with ADUs? It's a niche question, but if it could apply to your property or portfolio, which in NWA it often does, then it matters. Questions 19 and 20, tenant screening. This is one of the most important and most overlooked questions in the whole interview. Ask, what is your tenant screening process? You want to hear criminal background check, credit check, eviction history check, and employment or income verification. All four. If they skip any of those, you need to know why, and they're probably out. Then ask, what's your minimum credit score? ProX, our standards 525 or above with no collections, no evictions, no foreclosures, and no bankruptcies in the last 7 years. The applicant must have 3 times the rent amount in income as well. That's a defined standard. You want to hear a defined standard, not it depends or we evaluate case by case with no guardrails. Tenant quality is one of the highest leverage inputs in your investment. The property manager controls it. Make sure they take it seriously. Question 21, why should I work with you? This is a great closing question, and it's really the most revealing one. You're not asking for a sales pitch, you're asking them to articulate their differentiation. What do they do that the company down the street doesn't? If they can't answer that question with clarity and conviction, that tells you something important. They don't actually know what makes them better. And if they don't know, you can't trust that they actually are. So never hire a property manager who can't tell you what makes them different. So what good management actually does to your returns, let's zoom out for a second, because I want to put this in context. Most investors think about property management as a cost, an 8 to 10% line item on the expense side. That's really the wrong way to frame this, because a great property manager is a huge revenue driver. They get units leased faster, lower vacancy drag, they screen better tenants, lower turnover, lower damage costs. They raise rents to market, higher NOI. They catch maintenance issues early, lower capital expenditures long term. They enforce leases, fewer evictions, and legal costs. On the flip side, a bad property manager costs you far more than their fee. Deferred maintenance that turns into a capital repair. A bad tenant who destroys a unit. 3 months of vacancy because they couldn't get the unit leased. 6 months of below market rent because they were scared to raise it. I've seen properties trading at a discount that when you dig in, the entire discount is explained by bad management. Same market, same asset class, night and day performance. The management company is the only variable in some of the cases that I have seen. So it's important that you treat this hiring decision like it determines the return on your investment, because it does. Keep in mind, all those things can happen even with good management, but they're more prevalent without it. Red flags to walk away from. Before I wrap up, let me give you the short list of things that should end the conversation. They can't give you specific timelines or costs for the eviction process. This tells you they haven't done enough of them or they avoid them. They don't inspect properties or they charge a lot and deliver nothing. No Eyes on Your Asset is not a management company, it's a collection agency. Their answer on rent raises is vague or based in fear. You'll lose thousands of dollars annually to a manager who's scared of vacancy more than they're focused on your returns. They can't articulate why they're different. Commoditized thinking produces commoditized results. They have no defined tenant screening criteria. Gut feel tenant selection is how you end up with a nightmare tenant you can't exit without a $3,000 eviction. Any of these should give you serious pause. More than one is a disqualifier. All right, so let's put a bow on this whole subject. Picking a property manager is one of the highest leverage decisions you'll make as a real estate investor. It determines your cash flow, your tenant quality, your asset condition, and ultimately your equity. It deserves the same rigor you put into finding the deal, which is probably the only thing more important to the success of your investment than this hire. Use the questions we covered today as your framework. Go into every interview with them in front of you. Take notes on the answers of all the candidates. Compare the answers across candidates. You want a partner who's experienced, operationally disciplined, transparent on fees, aggressive on rent optimization, and who can tell you exactly what makes them the right choice. If you're investing in the Midwest or Southeast and want to learn more about how ProX Property Management operates, go to proxproperty.com. If you're looking at deals and want to talk about how our vertically integrated management creates an edge at acquisition, you can connect with us there as well. If this episode gave you value, share it with one investor who's currently interviewing property managers or who should be. That's how we grow this show. I'm Tyler Casey. This is the Ideas in Capital Show. See you next episode.